Hello and welcome to session 17 of our Series 7 exam overviews brought to you by Passing Score, where you can get more help on your exam prep at passingscorefinance.com. In this video, we'll be going over munis, and there's a lot to cover in this area, so we'll be breaking this topic into two different videos. Here's an example of the things that we'll be covering. But let's start with what is a municipal bond. It's simply a debt issuance made by a state or local government. And what makes it different from other types of bond issuances are that these are exempt from filing and registration requirements. They have what's called an official statement instead of a prospectus, which includes a legal opinion. In addition, they have lower coupons because they get certain tax exemptions as well, which makes them very different from a corporate bond. There's two major types of municipal bonds: general obligation bonds, which are backed by the full faith and credit of the issuer, and revenue bonds, which are only backed by the revenue coming off of a specific project. Let's say the tolls coming off of a toll booth or something like that. Otherwise, there's no guarantee by the issuing government. There's two different types of general obligation bonds: limited tax, which have a legal limit on taxes, and unlimited tax, which does not stipulate any tax limit at all. Now, you may think that since municipal bonds are issued by a government, which can always tax more, that's not always the case, and there is a credit risk involved with municipal bonds. Here are some of the major factors going into assessing how much credit risk you're taking with a certain bond, especially the economic health, the financial condition of the government, and its fiscal responsibility in the past. In addition, you'll probably want to know how much existing debt they already have, whether that's trending up or down. And a big factor these days is unfunded pension liabilities, which may limit the cash available to pay down debt in the future. A tool that we use to assess how much revenue is available for a revenue bond is something called the debt service coverage. We want this ratio to be high as possible, and it's simply the annual gross revenue less operating costs and maintenance costs divided by the debt service. Another tool that goes with revenue bonds is a feasibility study. This tells you gives you some idea on the ability of the project to generate the necessary revenue to meet its debt and all of its other obligations. This is done by outside consultants, includes an engineering report, if applicable, and takes a look at the legal documents as well, the trust indenture and the bond resolution, to give an assessment of the ability of this project to generate uh, revenue to cover all of its obligations, especially our bond payments. A flow of funds is telling you what the priority of payments are that are coming off of a project. So this is related to a revenue bond. So what order an operating fund, the debt service fund, and the replacement fund come when the money is flowing off of the project. The debt statement is telling you all the different types of debt obligations. So we have the direct debt, which is all the debt issued, the net direct debt, which is less any self-supporting debt, and overlapping debt. We have an idea called a coterminous, which means when a tax base can be taxed by a city as well as a school district, when there's overlapping tax bases. So the state may have one tax, the city another, a county another, and a school district yet another, and these are all coterminous with each other. A certain type of municipal bond is called a bank qualified. This is targeted to encouraging banks to invest in municipal bonds and making it easier for the issuing government to raise funds. There is a limit of $10 million per issuer annually, and the main incentive is that 80% of interest paid is, uh, is deducted by the bank, which makes their investments have a higher return. Now, here's the different kinds of revenue bonds. There's a lot of different ones going on here. So we'll take a quick look at each one. There's the IDR and Pollution Control Revenue Bond. IDR stands for Industrial Development Revenue, and this is to encourage business growth, job growth in a certain area. The bond is usually backed by a lease agreement with a firm that's tied to the facilities that were created by the bond. And this is exempt from federal tax unless the issuer, the government, is the primary user of the facility. A special revenue bond is backed by a special tax that's targeted just for this bond and can also be guaranteed as well by the entire taxing power of the issuing government. There's the double-barreled revenue bond, which has backing from two sources of income. So it's known as a combination bond also. You might have a bond that is backed by the funds from a project plus the taxing power of the issuing entity. A moral obligation revenue bond also has different backers, but they're different legal entities. So a city might issue a bond that has some implicit backing from the state as well. Uh, this must be approved by the state legislature before it's issued, and the credit rating of the issuer, the city, county, or local government, and the state would be negatively affected if there's some kind of default. But the main idea is that both are pretty much on the hook for meeting the obligations of this bond. There's a parity municipal revenue bond. This brings in the concept of a pari passu, which means that a bond is issued that has the same seniority and rights as the senior bonds that were issued prior to this bond. So it gets the same rights and doesn't have to settle for being a subordinate bond. And in project revenues are shared on an equal basis. So it gets the full first priority, even though it was issued later when it normally might be a subordinated bond. There's a taxable municipal revenue bonds as well. So not all muni bonds are tax exempt. If certain conditions are met, which in this case is issuances of greater than $150 million, which is the limit in certain cases of how much tax exempt bonds you can issue. If the project finance does not provide any public benefit, and there's something called the Build America bonds, which have been issued in the past few years, which are taxable but offer a tax credit instead to make them more appealing and make it easier for governments to raise funds. There are PHA or NHA bonds. These are Public Housing Authority or New Housing Authority revenue bonds. These were issued in order to create low-income housing. These aren't issued anymore, but they're still traded, and these were usually backed by the Housing and Urban Development Department of the federal government. There's pre-funded or defeased muni bonds. These are debt that have been essentially prepaid in a separate fund that is put in escrow, usually backed by treasury bonds or some other very low risk or risk free types of bonds that make the payments on the muni bond. So, in essence, it's the city or state government has disconnected itself by setting aside the funds to completely pay off over time the municipal bonds. And that frees up the collateral that they may have had in relation to that muni bond issuance. There's private activity or AMT bonds. In this case, the bonds have been issued to finance a private project, so they're no longer get the full benefit of tax exemptions. This is 10% or greater of the proceeds of the bond, of the revenue project, I should say, or 10% or greater of the proceeds are secured by private property, not the issuing government entity. And they're called AMT bonds because they're now subject to the alternative minimum tax, which means they can be taxed as federal income. There's certain provisions and covenants that are key to the legal structure of a municipal bond. There's rate covenants, which for a revenue bond assures that the price, the tolls, or the whatever the fees that are backing a revenue bond will be maintained at a high enough level to cover obligations. There's a maintenance covenant saying that the project will be properly maintained, insurance, non-discrimination. In addition, there's closed-end indentures, which says that no additional bond issues can be made in relation to that project, or open-end indentures, which says that they can if there's some need for expansion. There's covenants that say that the project has to have proper financial reporting and auditing, and there may be something called a catastrophe call. In this case, if there's some uncontrollable event, the bonds can be called back earlier than the maturity. Now, a revenue bond fund is an account that receives and records all the receipts coming from a project. And we saw that there's operation and maintenance funds, which uh, are set aside to maintain the good working order of the project, the debt service fund, and a debt service reserve fund as well. In addition, we have a reserve maintenance fund, replacement funds, a sinking fund, which may be required as one of the covenants, and a certain surplus fund if there's any excesses after all the other obligations have been made. There's also something called municipal notes, and there's different types of these. Usually these are, as you can see by these descriptions, are short term before some other type of expected revenue comes in, whether that's from tax receipts or a long-term borrowing that will take the place of this short-term borrowing. Moody's ranks the different municipal bond issuances with a separate credit rating process. The MIG, they go 1 through 4, which is measuring the credit rating of the bond issuance. And this is the same for standards and poors. We have strong, satisfactory, or speculative. There's something called auction rate securities, which are long-term bonds with short-term variable interest rates or dividend rates. These rates reset every 7, 28, or 35 days through a Dutch auction process at each of those time periods. The lowest acceptable bid at the clearing rate becomes the new interest rate for the period. And we can see this may be for a 10 or 20-year bond, and it's unusual in that it has these short-term rate resets. So it has the characteristics of a short-term bond as far as interest rate risk, but within a structure that's a long-term maturity. We also have auction orders, which are related to these auction types of securities. There's the hold or roll order, the hold at rate or roll at rate order, and a straight buy or sell order. In addition, we have something called a variable rate demand obligation or VRDO. These are long-term bonds with short-term resets, but unlike the auction securities, these don't reset based on an auction. They reset based on the market price of interest rates at that time, so that the bond is reset to par at that daily, weekly, or monthly reset time. So this is market driven rather than from as far as the interest rates being set instead of being done through an auction. That's it for the first half of our Muni section. If you have any questions, please feel free to email me at john@passingscorefinance.com. And we'll see you next time for the second half of our Muni section. And good luck on your exam.